Okay.
I think we're live.
We're live.
And we have sound this time.
Okay. All right on, Trevor. So today, thanks for coming back to the Beat the Odds podcast. Today we're going to be talking about real estate in Canada. We'll continue on from where we were last week, I think, Trevor. So
Yeah, because last week we discussed the interest rate reduction by a quarter point.
yeah,
Doesn't really affect things massively, but it's on everyone's mind. Especially, it's a big talking point with the government right now. Housing. We have a housing shortage.
Yeah.
Right. We have a supply and demand problem with housing. So I think this is a really good topic that people will want to hear about today. So if you do want to hear more about this and you like the content, don't forget to subscribe, click, share it with your friends, and so let's get into it.
So we left off last week, Trevor. We'll just pull up that screen with the Canadian total residential real estate, and it's just shy of $6 trillion, $5.9 trillion of real estate in this country. And despite everyone's perception of it, there's only $2.2 trillion of debt on it. And so if you looked at it as a single portfolio, it's a loan to value of 37%. So basically for every $100 of real estate there is in the country, there's only $37 of debt on it. And that's hard for the average Canadian to understand sometimes because the top 20% own 73% of all the assets. And so, there's people struggling because they put, 5% down, 10% down, 20% down. It's hard for them to fathom that on the loan to value in the entire country is only 37%. In fact, roughly a third of the real estate in the entire country has no debt on it whatsoever. Wow. And a lot of the people who have debt on real estate, they don't need to have the debt on real estate. They could pay it off tomorrow. Yeah. They're just earning a higher rate of return elsewhere in their capital structure. So that's hard. And it's, I think the advice out there is more nuanced. We always talk about the Dave Ramseys of the world and just pay off your house, right? Yeah. But I'm not sure if it really contemplates what's actually happening today. It's like you used to be able to buy a house with 6 years of median income. And now, it takes 20 years of median income. Life has changed since Dave Ramsey built his wealth. Like it really has changed, right? And I tell people, if you think debt is the enemy, it's like, forget about Dave Ramsey. Just go look at the big juggernauts of the world. So just look at the Facebooks, the Googles. Just go look at their financial statements, pull up their balance sheets, and you'll see that they're sitting on tremendous amounts of cash, and they still have debt. And so when you start to understand that, it's that the most sophisticated entities on planet Earth, who could pay off their debt, use debt to increase their financial performance. But where the average person gets into trouble is that requires expanding your knowledge significantly. Yeah, it's not just as simple as not using debt or taking out as much debt as possible. It's when to use debt, at what rates, what are healthy ratios to have on your personal balance sheet. That takes a lot of work. Right. But in this day and age, it's like if you want to break into that top 20%, or if you want to break into the top 1%, you're just dramatically reducing your odds of getting there if you don't understand how to use debt.
Yeah. And just like we talked about last week, the banks will happily give you a $100,000 loan for a truck. Yeah. For a piece of rusting metal that's going to lose its value almost immediately as soon as you drive it off the lot. That's not going to really benefit you a whole lot. They'll happily give you that. They'll happily give you underperforming RSP to build your wealth because you're richer than you think. And really the opposite is the truth. They won't give you a loan to invest in, good stocks and it's very difficult to get into real estate because, like you said, you need 20 times your median income in order to purchase a piece of real estate.
Yeah. I mean, that's the thing. People say they won't give you, they do. It's just not they will give you a loan to invest in stocks. It's just not the product they advertise to you.
Yes.
That's not the one that they're going to advertise, right? And so, I point out, we're trying to walk people through the path, and it can be a slow path, but it's a rewarding path, and that's what this podcast is about. Is it's how do you get rich, forget about get rich quick. Let's get rich for sure.
Yes.
Okay. And the system's designed to move the wealth from those who earn and save to those who borrow and invest. People don't understand that. They think about the risks in the housing market. And we're talking about real estate here. And we're going to bring up the current day prices. But the biggest risk in the system remains the same. And the biggest risk in the system is that there is going to be a continual debasement of the currency and the value of what you do every hour. And it doesn't matter what you do. I'm an accountant, you're a mortgage broker. You could be a dentist or a bricklayer. The value of what you do every single day goes down in relation to the desirable assets that you want to buy. That's a hard realization for people. It's like, forget about the government CPI. Just start looking at valuable assets. Stocks, real estate, ounces of gold, Bitcoin. It's like you will buy less and less of them with every hour worked. And it's not always true every month, and sometimes it's not always true every year. But you zoom out 10 years, it's true. Like that is the way it's going to materialize, right? And it remains the biggest risk, right? Can you have a pullback in real estate prices? You can. You might. How big will it be? With a housing shortage in Canada, like, is it going to be 20%? It could. Is it likely? Not likely. But, so if people start organizing their life that way, it's like, you have to have a healthy relationship with debt where, people are using debt properly. I'm using debt. I have more debt than most of my clients have. And am I annoyed at 6.95% interest? Yeah, I'm annoyed. Would I like it to be 3% as a selfish investor? It's like, yeah, I would like it to be 3% as a selfish investor. It's like, am I going to get margined out? No way. Like, they could double it and keep it there for a decade. Like, it's not going to, it's not going to margin the people at the top out, right? And so it's about taking a healthy amount of risk with debt, because I find that people, they think that debt is evil, or they don't understand the risks associated with it. And it's about optimizing your risk reward, and that's what can be done with real estate. And so, the next part I point out is because we're used to buying real estate with debt. It's been normalized,
right?
People want to buy a house, they get a mortgage.
Well, let's be honest. Everything nowadays kind of gets bought with debt.
Yeah, I mean,
unfortunately, it's true. People, rank up their credit card debt and, private loans and student loans and so forth. Most everything is bought with debt. Right?
Well, the entire monetary system is debt. Every dollar that's in existence has been lent into existence either by the central bank or a commercial bank. But that's a topic for a different day. It's like, there is no money without debt. That's kind of how the fiat system is designed. But although it's, normalized to, get real estate with debt, people don't understand. It's like, anyone contributing to an RRSP who has a mortgage, which is most people, they're using debt to invest. Right. It's just that they've been tricked into thinking that somehow they think that, well, I didn't borrow directly for the RRSP. It's not an RRSP loan. So this is in this bucket over here, and my RRSP is in that bucket. But, I have $50,000 in my RRSP, but I put 5% down on my house, and my house is at 95% loan to value. It's like, you borrowed to invest. That is what you did here. It doesn't have to be directly tied to it. And when people start understanding that they're almost always using debt to invest, whether it's in a house or whether it's in an investment account, it's like, if they have debt on their personal balance sheet, you're using debt to invest. And once you do that, you can step back and start to see, it's like, one of those debts was not good and one was not evil. It's not like borrowing to invest is bad and borrowing to buy real estate is good. It's having a unhealthy debt ratio. And so, like, what is my ability to service that debt? How liquid am I? If the only asset that I have is real estate, and I can't, real estate by nature is illiquid. It can be hard to sell, and especially the more specialized, higher end real estate, it's like it's harder to sell. It's like, it's a long-term asset. You could try to sell it in a month, but you might not get the best price for it if you had to sell it in a month. Your stocks, you could sell them in a day. You get the cash. They're a liquid asset, okay? And so people have to understand it's like there's no one debt that's good and one debt that's bad. It's what's that overall debt ratio? And if people start understanding that, it's like, what is the, what are all my assets worth and what are all my debt? Then they have to understand how much, what percentage of my assets are current, okay? And so if I have, $2,000, $3,000 a month in, let's call it $2,000 a month in mortgage payments, okay? That means over the next 2 years, I'm going to make $50,000 in mortgage payments. I would say, do we have $100,000 in liquid assets? Do our investment accounts have $100,000? Okay, so we could make all those mortgage payments for 2 years just with our liquid investments.
Right.
Okay, now we start to get into the healthy ratios. If we can actually have that debt.
Okay, but let's be real here. Most people will never get to that level. Like they'll never have $100,000 just sitting there in liquid assets, whether it's gold, stocks, other precious metals, Bitcoin. Like most people aren't going to get there, right? So especially if they have a T4 job, most people will not reach that. Like I would probably venture to say a good 90% of people wouldn't get to that point, excluding the top 20%, right? So how do they get there? Like what's the path?
I mean, it's how you eat the elephant. It's just one bite at a time, right? I think one of the most profound thing people can do is just start acquiring some liquid assets, buying, some solid dividend paying stocks in an ETF through your TFSA, $100 a month. I think that's like a baby step. Dave Ramsey has his baby step. It's like, I want to see someone like investing $100 a month into quality dividend paying stocks in their TFSA. And I would even say people who have credit card debt, and this is one of these things where it's like, I'm doing it for a psychological purpose, not for a mathematical purpose. The same way Dave Ramsey would say, pay off your smallest loan first, even though it might not have the highest interest rate. Totally mathematically incorrect, but psychologically beneficial. If I'm dealing with a client and they have some credit card debt, the $100 a month that they're putting in their TFSA is not going to outperform their credit card interest rate.
Right.
I know that, but they need to see what's possible. They need to understand you put $100 a month into a dividend ETF in their TFSA, and they come back next month and they put 30 cents in their account. And the next month they put another $100 in, they put 60 cents in their account. And once people understand it's like that is possible, now, the wheels start turning. It's like if I could get the debt running the other way, if I could get my high interest debt paid off and I could reallocate that to an investment account, I can start making some money. And then it, opens up even further where if I understand that I can generate a consistent yield off of my income, am I actually I would actually be comfortable taking on debt because I can use that investment income to service the debt.
Right.
And that starts to change the way people think, right? And I view that as a baby step that, I give a lot of people that recommendation. And again, I know it doesn't work out on the spreadsheet, but just my experience on dealing with people. We're dealing with emotional people.
Yeah.
And if they see that progress and if they see the ability to earn money from their money, now that's motivation. It's like, now I really want to get that credit card paid off, because once I get it paid off, it's like, once I get it paid off, I forget about $100 a month, I can start saving $1,000 a month.
Right. And yeah, like you said, it's really a psychological practice or exercise to build that muscle of saving and investing, and not, maybe going out for dinner an extra time that month. Yeah. Rather just take that $100, put it into dividend paying stock or into an ETF because it's simpler to manage, so that they can, build that muscle. It's about doing the reps and building that discipline. Kind of like going to the gym or running. It's like you don't start off, lifting super heavy weight or running a marathon. It's a game of inches. I like that analogy that you use all the time. Like, winning is a game of inches. Maybe talk about the analogy you shared this morning about the last Oilers game that we saw.
The life is a game of inches, right? Yeah. It was the play where Matthew Tkachuk, the Oilers dumped it down towards the empty net, and Matthew Tkachuk, love him or hate him, like, the guy made one of the best plays I've ever seen in professional sports, where he dove and knocked that puck off the goal line, like just a complete all-out effort. And meanwhile his defense, Oliver Ekman-Larsson, the defenseman, totally gave up on the play. Like, he just assumed that puck was going in. So Tkachuk, he knocks it off the goal line in one of the most spectacular plays, and Connor McDavid just picks it up. And meanwhile, Oliver Ekman-Larsson looks like he's curling off to go to the skate to the bench, and McDavid just buries it into the empty net.
Yeah.
And before then, Oliver Ekman-Larsson had played a good game. The guy scored a goal, and but he played 59 minutes and 40 seconds of a 60-minute game, and everyone's only going to remember that last 20 seconds. and so, like, a lot of life is like that, right? It's like, how do we get that extra $100 a month to invest? It's like the differences are kind of on the margins sometimes, both in business and investing and kind of life in general, right? Yeah. It's that last that last 1% of effort sometimes makes all the difference, because ultimately it's like, either did you start that $100 a month in investing, right? Because tying it back to what we're doing is real estate. It's like, if you understand how to make money from your money, now you can start to actually evaluate, should I take this debt on and invest it? Mm-hmm. But if they've only ever invested in an underperforming mutual from the bank, and I see this all the time. People got $100,000 in a mutual fund, and I come back 2 or 3 years later, and the market's done well, and it's worth 102. It's like, it hasn't even kept up with inflation, and there's the market goes down sometimes, and that's not the bank's fault. But when the market's doing good, and you're getting like a 1% return on your investments, like, it's just like, of course they're never going to consider it. They'll just pay off the debt, right? Because they never actually were exposed to anything where they can get a higher rate of return consistently. And I would say there's sectors that we talk about in the TSX at our bootcamp where it's like, consistently they've gotten 10%. Mm-hmm. Consistently.
Yeah.
And when I show people the names of the companies that have done it, like, not for a year or 5 years, for decades, they've gotten a consistent rate of return. I like to call them the government-controlled monopolies.
Yes.
Right? The government-protected monopolies, right?
Yeah.
And so we start looking at that. It's like, people are always using money to invest. And like I said, we've normalized mortgage debt. And somehow we've normalized car loans, which are always a money loser.
Man, I hate car loans. I absolutely despise car loans, because most cars aren't worth it. They're just, the value of that car, that vehicle, that truck just doesn't fit to me. The value isn't there. Especially nowadays, you're looking at $60,000, $70,000, $80,000, $100,000 for a run-of-the-mill type of vehicle that everybody would need to use, right?
Yeah.
Back when I was, growing up in the 80s, you think 100,000, 200,000, that's like a Lambo, that's a Rolls Royce, right? And here you're buying a pickup.
Yeah.
Like, it just doesn't compute in my brain as to why is that so. But anyway, hate car loans because they're a big waste of money, high interest. They don't provide value.
Yeah, and someone would say they have no problem taking on a car loan, but the minute you say it's like, okay, we can borrow money off a HELOC to invest, that's evil.
Right.
It's like, no, just stay out of that car loan, right? Mm-hmm. And if we start to understand what's possible, and this one resonated with a lot of people. And we saw, sometimes you post something that's interesting to me, but it's like, 277 people like this post, right? And you could just kind of see it, right? I think this is the unfortunate truth is the average Canadian today cannot afford a new car.
No, but they keep giving them loans.
The banks will lend you the money. That doesn't mean it's a good idea, right? And so when the bank tells you that, one type of debt is healthy and one that's not, it's like I question the bank's motivations because they give car loans away like candy. The conventional wisdom is like, hey, get your mortgage done first and get your car loan second because, man, they'll give car loans away. Like it's almost criminal. Like, people just winding negative equity into cars and the banks just are complicit into it all the time, right? And this is where people get the unhealthy relationship with debt. It's like, I'm going to take on this mortgage and it's going to bury me. It's like, it's probably the car loan that did it.
Or car loans.
Yes, or car loans. Two cars in a household, and they're both on loans, and the loans are wildly more than the investment accounts altogether, right? That's a problem. Okay, so then we get to the rental prices by city. It's like, just like we can make money off stocks, we can make money off rental real estate. And we should understand what this is. And so we organize this chart every single month based on, where the highest rents are. Vancouver.
Of course.
Always number one. Yet to be.
Some of the highest real estate prices in the world.
In the world, right? And, people rag on Vancouver. It's like, but I don't know. I like Vancouver. We know we have an office there because I like going to Vancouver. That's why we have an office in Vancouver, and I own real estate in Vancouver, even though our head office is in Edmonton. And it's expensive, but it's a world-class city too. For someone who's traveled, it's legitimately a world-class city. There's not many other walkable places like that in North America.
Yeah, some of the largest homeless encampments, right in East Hastings there, just like other large cities in the world.
They're very good at, I don't know if this is politically correct, but they're very good at migrating the homeless population to a very concentrated part of town. So you can walk around, Cole Harbour where our office is, and it's pretty darn good. But if you wander too far in the other direction, and that's different than Edmonton. You do that in Edmonton, and it's like, they're kind of like, the homeless population is all around.
All over the place.
We're not very good at corralling them, so I'm not sure which one has more per capita. Maybe Vancouver has more per capita, but they're better at consolidating them into one location. So for better or worse, I'm not sure it's solving the issue, but the nice neighborhoods are still pretty nice there.
Yeah, for sure. It is by far one of the most beautiful places in Canada to go visit, for sure.
Yeah. Burnaby, just a stone's throw away. We're still really talking about the greater Vancouver area, and then we get into Toronto. But we're looking at this. It's like $2,600 for a 1-bedroom and $3,600 for a 2-bedroom, right? And I think if you're in those cities, that's a real tough place to start. Mm-hmm. If you're making a median income. So if you're making a median income, $30 an hour, we post those wage stats every month, right? So someone making a median income of $60,000 a year.
Yeah.
Oh, okay. I question why you're living in these places. That's why? If you're on the brink of getting a massive pay raise, maybe that's one thing, right? If you're in some really cool program, articling position, you're just a year or two away from getting a big raise.
Sure.
I get it, but if you're making $60,000, you're hoping you're going to get a 2 to 5% raise next year, and there's nothing else beyond that. It's man, I don't know why you're in a place where the rent is that high.
Yeah, there are much more affordable places in Canada. You can go to Alberta, which is quickly going up there, especially Calgary is pretty expensive at this point. But there's Saskatchewan, there's Manitoba. Those places you can get very reasonable rents, which we'll probably see in this slide here.
Yeah, so we see the pullback a bit in Vancouver, but it's still, it's still really high. Toronto, yeah, we're starting to see the pullback in rents in these locations, but that's not all across the country. And I think people, sometimes they just look in their own reason. When you get out west, you're going to see a lot more green on the sheet here. Interesting that Victoria was still very, very resilient, right?
Yeah,
it's such a small market that it's a very niche place, right? So supply is forget about supply being constrained in a Toronto or Vancouver. It's supply is really constrained in a place like Victoria, right?
Yeah, geographically, you know, it's an island, right? Yeah. So there isn't a whole lot of extra space to be putting cities. I mean, they have tons of space there, but it's not like it's easy to get building supplies there, the labor to actually build the homes. And I'm sure they have some controls because, you know, anybody who's been to Victoria, it's a very beautiful, picturesque type of place. They're not going to put a bunch of, you know, high density housing there. They want it to be, you know, very beautiful and very controlled to maximize the value of that area for tourism and so forth, right?
Yeah. And I look at this, it's like, you know, you can even see the migration even interprovincially, like even in the greater GTA, like you can see it flowing out of more expensive Toronto and into less expensive Mississauga and North York. And so you can see that, like people have reached their kind of breaking point, right? And they're starting to migrate to different places. So, you know, walking through, you know, we look at page 2 here. Halifax just stands out to me. It's like 3.8% on a 1-bedroom and 16.3% year-over-year growth on a 2-bedroom in Halifax.
That's nuts. Why the growth in Halifax? What's going on there? People moving out of Ontario?
Yeah, people move out of Ontario. It's also a very nice city too. You know, I've had the experience of spending some time in downtown Halifax, and it's a nice place. You know, the harbor is right downtown, and so like I get it. People gravitate towards these nice places, right? You know, might not be the most favorable for tax perspective, but people like nice places, right? And they'll spend more in some of these nice places. So you've really seen that price appreciation in Halifax. Both on the rental side and on the price side from purchasing there. So, and you can also see, you know, going down the list in Ontario here, it's like, okay, Hamilton, okay, they've had a pullback, but Brantford and Kingston, big increases.
Wow, that's really big.
Big increases. People moving from the higher price jurisdictions to the lower price jurisdictions because they've reached their breaking point. Those wages are not, you know, if you look at the wages last few months in Canada, it's like they're kind of stuck. You know, the median wage is around $30 an hour. And it's like, of course, I always take issue with the median wage because it's difficult to separate out the private and the public parts of those median wages. But if we just take it at face value, it's not moving. Hasn't moved in a few months. It's been stuck, you know, pretty much at $30 an hour. So there was some increases previously, but, you know, not anymore, right? You know, then we start to get a little bit out. We start getting out west, right? We get into Nanaimo. We get into Calgary. Montreal's still strong too. Montreal's still strong. You know, considerably more cost effective than in Toronto. And we're just seeing this across the country. People are moving out of the more expensive jurisdictions and into the places where housing is a little more affordable.
Yeah, well, I mean, it does make sense because, you know, if you can't afford where you're living now, you have to think of other plans. Just, you know, choosing between rent and groceries, you know, I think people like to eat.
Yeah. Interesting to me that Gatineau is actually just edged out Montreal there, but that's a side note. But Calgary, 6% growth on both the 1-bedroom and 2-bedroom, $1,700 and $2,100 a month for a 2-bedroom, and the migration to Alberta is shocking.
Yeah, it's huge because, you know, we have industry, we have resources, we have a popular government, you know, love it or leave it kind of thing. A lot of people may not appreciate the conservatives, but we're really a conservative province because we value entrepreneurship and oil and gas, forestry, minerals, mining, so forth. I mean, that's the beauty about being in Alberta.
Cheaper housing, more jobs, people start showing up. And that's kind of what's happening out west, right? And Calgary's always first, and Edmonton's always kind of second in that kind of play. But, you know, I saw some stats, you know, over 4% year-over-year population growth in Alberta. And for perspective, that's like, you know, some of the countries in Africa who have, you know, massive families, right? Like 4% year-over-year population growth is a breakneck pace anywhere in the world. That's a lot of growth.
And it's reflected in the home prices and rental prices.
But I mean, hopefully they're going to have some water. Maybe that's hopefully the taps still work. That's a whole other issue altogether, right?
Things are probably getting stinky in Calgary right now because they're running out of water. Yeah, they have.
But look at the final page on the chart. I mean, the final page on the chart are the most cost-effective places in Canada, and they're all green. Everything's green. So like going back to the first page, it's like, look at what we have here. It's like all the pullbacks in the expensive jurisdictions. And you look at the cheaper places in the country, it's like growth after growth. Like they run, they ran the tables here on this, right? Edmonton, 16% year over year on a 1-bedroom, 12% year over year increases on a 2-bedroom.
Wow.
That's a lot.
That's massive. So if anybody was thinking about buying real estate, get that basement suite in, rent out a room. Like now's the time you can pay down that mortgage or pay off other debts, or just start investing in other assets with that revenue that you can get from rentals.
Yeah. Even a condo. I mean, you look at a condo, it's like, I like when people start with a 2-bedroom condo, because that's going to get them into the real estate market. But here's the caveat on the 2-bedroom condo. If I'm giving someone advice, it's like, buy a 2-bedroom condo. People are like, I'm just going to wait to save up for the house. It's like, okay, well, that house might keep running on the price while you're saving. The 2-bedroom condo, get a 2-bedroom condo and rent out one of the rooms.
Yeah.
Like if you start looking at the difference here, it's like like we just look at what someone's paying for a 1-bedroom in Edmonton. It's like, do people understand what the difference it makes on an extra $500 or $1,000 a month? $500 to $1,000 a month to take on a roommate. What that makes month over month, year over year on your net worth. It's a big difference, right? And so when I tell people, it's like, I think a good starting point is a 2-bedroom condo. Some people will argue with me, but they forget the second half of my strategy is I would rent out another room. Right?
Yeah, for sure. I mean, and right now you can probably get $700, $750 for renting out that room, right?
And I tell people, like, a lot of like the things that I tell people, like, this is what I did. Like, you fast forward, you go back, 15 years, like, that's what I did. I bought a 2-bedroom condo and I rented out one of the rooms, and I still rent out that condo today. Haven't sold it. It's just going to pay me every month for the rest of my life. And I don't think people are, sometimes they're maybe not, they want that glorious scenario where they think they're going to move into their dream house on day one. It's like, you're not richer than you think, you're poorer than you think, but you can get richer than you think if you make some sacrifices. There's an idea of one. It's like, you can still get a 2-bedroom condo in Edmonton for $200,000.
I know. That's the crazy part. You can still get a decent one downtown,
and rent out that second room for $500 to $1,000 a month. And people are saying, I can't afford a house in Canada. It's like, well, no, you just can't afford the lifestyle you were sold. Like but if you start looking at like what are the cracks in the system, it's like, that's the way to start. Knowing what those rental rates are, it's so important, because ultimately real estate is worth what you can rent it for. So when you start buying real estate for more than what you can rent it for, it's like, okay, that's where the risk actually exists, right? It's not going to drop below a point where anyone could buy it and be cash flow positive on it, right? And you're seeing some of the stuff come back down to reality in Toronto especially. So then we look at the national price map that we put up there, and you can see the pullbacks in the two most expensive jurisdictions in BC and Ontario. BC down by 1%. They're just over $1 million. The average housing unit, and that's a housing unit, not a single family house. So there's a difference there.
Yeah, massive difference. That can be an apartment, a small bungalow, or
compound,
or a compound. Yeah,
it's an average housing unit.
The average storage unit in Vancouver.
And so people are contemplating that real estate crashing across the country. It's like, no, real estate's down in Ontario 3.7%. It's down marginally in BC and up everywhere else in the country. It's like, okay, so what were you buying? What was so special about that 2-bedroom condo that you bought in Toronto? Was it worth 5 times more than the 2-bedroom condo that you could buy in Edmonton? Could you rent it out for 5 times as much? Because it costs 5 times as much. And so people have to understand, like, what did they buy? What was the downside risk on it? You know, what was the, what could it be rented out for? And so you start with the rents, and then you work your way up to what it's worth, okay? And you can start to see, like, what's actually happening. And people have to understand, it's like, sometimes they have to move. Like, you can't be waiting for the government to fix your problems. You can't be waiting for, your guy to win the election, and somehow you think, you're going to be able to live in, downtown Toronto or Vancouver.
Well, I'll put the challenge out to people right now is like, when has the government ever solved your problems? Yeah. Or have they created more of the problems? And we just have to be better problem solvers.
Some are going to be less worse than others.
Pick the best of the worst.
That's about it. But, we're not going to have this magical supply of affordable housing in the most affluent areas overnight.
No.
At scale.
No.
And so, like, we have to understand, like, where the opportunity is and, like, what is your income earning potential in the area that you're at right now. Does that justify living in a place where housing is that expensive? Are we serious about getting your wealth, to $1.2 million at least to get comfortable? And are we serious about getting to 7.3 million to hit the top 1%? It's like, or I just say it's like, I have to live close to grandma. It's like, difference between $1 million condo and a $200,000 condo. You can buy a lot of plane tickets to go back and visit grandma. A lot.
True story.
A lot of plane tickets. And so people have to get serious, and they have to, fend for themselves and stop waiting for something to magically turn around. Interesting. We start putting the different jurisdictions in here. Powell River takes a hammering 31%, but I post these, and sometimes people think that they're more than what they are. They have to understand that, the smaller the region is, like, this is just raw average data year over year. I don't look at these and start thinking that Powell River is collapsing. You look at this and just say, okay, you get a couple of big sales last year at this time and a couple of smaller units moving at this time, and it starts to look bad. It's like, you got to look at the trajectory of these over time, right? So the smaller the area you're looking at, the more you should expect a wild number appearing, higher or lower.
Right.
And so, but we post this. I did notice that the Greater Vancouver area was conspicuously absent from this month's report, but I didn't dig into it that much in the spreadsheets. But it's like it wasn't a typo on our end on that one. It was just like, it actually wasn't there at the time we posted it. So we'll look for it next month. But that's what we're seeing in British Columbia. And then we get to Alberta. Alberta West, relatively small market. Fort McMurray is just still taking a beating. Like, they have been taking a beating ever since 2015 in that market. Like, that has been
because during the big oil boom during the early 2000s, I mean, you couldn't find a place in Fort McMurray. Like, it was just, the market was nuts. Things were going way overpriced. Even mobile homes were going ridiculous amounts of money.
Yeah.
And then now they're just getting hammered because they've had fires, floods, more fires, and the industry getting kicked when they're down too.
Yep. Industry, and it's one of those places where the beauty isn't going to you're not going to get a whole bunch of foreign investors who just want to live in Fort McMurray for no other reason whatsoever, right? Like, it's not like a Vancouver or downtown Toronto. It's not going to have that international appeal. It's people who want to live there and work there, right?
Yeah.
And so you constrict the industry, it's going to have some challenges. But the rest of Alberta, extraordinarily strong. You start looking at like things like big markets. Like, when you see big markets like Edmonton or Calgary, and they're up 6 or they're up Edmonton 6%, and Calgary up almost 10% year over year.
Wow.
Like, these bigger markets are less skewed by 1 or 2 sales, right? Like, this is a real number, even on a month-over-month basis when you start looking at the bigger metropolitan areas. That's just the reflection of the migration patterns. People are moving out of the more expensive jurisdictions and into these jurisdictions, and landlords who want to take a shot at it. It's like, yeah, there's pretty good demand for rent at this point. So people are saying that you might watch the CBC, and they're painting categorically that landlords are getting crushed. It's like, they're getting crushed in Toronto. They're doing much better in Calgary or Edmonton than they were a couple of years ago, because there's no more free month's rent in Calgary or Edmonton to get a tenant in the door. It's like, sign here, show me your credit report, or we're moving on to the next one. It'll be rented by the end of the week.
Yeah, I was working with a client in Edmonton, but they were trying to find a place just to rent in Calgary. This was last year or the year before. Yeah. And, people would call, a place would go up for rent, and there would be multiple calls for that place for rent. And it was a competition. It was a fight to try and get a place to even stay and rent in Calgary. And I don't know how much that's changed now, but I'm sure it's not getting any better.
Yeah. And so that's the supply that we talk about. Then we move on to the juggernaut in Ontario, and we start looking at some of the big pullbacks. So it's like, okay, it pulled back from 1,383,000 to 1,287,000. It's like, the minute you get over $1 million in any area, it's like, it's a different animal financing it. And this is, I mean, Trevor, as a mortgage broker, it's like, these are not, CMHC approved loans. These are not insured loans anymore.
No.
These are, you're putting down 20% on something like that. So the difference on selling something that's 900,000 versus selling something that's 999,999 versus 1,000,001, totally different.
Completely different animal, because you got to have 20%, sometimes even more, depending on the lender. And it's much tougher to qualify at that point, right? And a lot of people have debt. They've got the car loans. They've got other things that maybe pushes their GDS and TDS out of the range. So under that million, they have a good opportunity. So I'm thinking, my suspicion is that they're going to change that limit. They're going to move it past $1 million, because homes are just going to be...
It's been it'd be interesting, like, when was that $1 million limit? I can't remember the year, but it's been, I want to say that's at least a decade.
Yeah, I think it's time to change it.
That thing has been there for a while, and it's a different. We see clients, very well qualified clients. These are clients that are firmly in the top 20%, and sometimes in the top 1%. And it's like, we tell them, if you're buying luxury real estate, it's like 35%. We want to have 35% down. Like, you're buying a $3 million place. We're putting $1 million or more down on this thing. It's like, because that's what's going to get us the grade A financing. That's also going to get us access to a HELOC.
Yes.
65% loan to value. Now we have a HELOC. Now we can borrow money at 5%, right? And this might be someone who's, let's call it a $2 million place. Okay. Putting $700,000 down. It's like, now they have access to a HELOC, and this person might have $2 million. They have $2 million in cash. This is what blows people's mind. Right. It's like, they could buy the entire thing in cash, and we're going to say, no, we're not going to buy it in cash. It's like, we're going to put 35% down. We're going to get the best possible terms. We're going to open up a HELOC, and we're going to continue to use that capital. We know how to invest it at 10%. Historically, you're going to pay interest at 5%. Maybe it's 7.5 today, but like, we're not making the decision because of what it is today. We're making the decision of what it's likely going to be in 25 years. That's why you buy assets, right? If you buy an asset that you didn't want to hold for 100 years, it's like, you bought the wrong asset. And so people like panic selling on houses. Like, okay, why are you panic selling? How far did you extend yourself when you bought it? The answer is not to buy it because you think the sky is falling, right? And I see this because this gets a lot of clicks these days. People are getting scared out of the market by people posting foreclosures all the time. It's like, but people get foreclosed on in boom times.
Yeah, all the time.
It's like, there's always someone getting foreclosed in any major city in Canada. It's like, finding that every day and posting it is stupid, because the main risk to everybody is the value of what you do every single day. The hour of your time goes down in relation to the assets that you want to buy. And that's, where I take issue. So if people are scared away from the housing market, it's like you have to be cautious. You have to be thoughtful. Maybe that house you should buy is not in Greater Toronto area. Like maybe you shouldn't buy that $900,000 2-bedroom condo in the GTA, right? Maybe you should buy the $200,000 2-bedroom condo in Edmonton instead, because that's a more certain thing, right? And people just have to understand, it's like the goal is to own assets. The goal is to trade our time for fake money and buy real assets.
Yes.
And if we can borrow fake money at reasonable terms, and we have good liquidity and strong earning, it's like the answer is to keep doing it. The answer is not to eliminate all debt. The answer is to increase your net worth.
Yes.
And that's where it kind of blows people's mind. Is like sometimes if I'm talking to someone, it's like I have no problem with an 80-year-old having debt.
Right. Well, the bank has to collect from an 80-year-old.
Yeah, I mean, if they pass, they have assets. The goal is not to sell off all your assets before you die, right? The goal is to pass the assets on to the next generation,
right?
And so, why are we going to slow our growth rate down below inflation? That wasn't the goal. It's like, am I worried with someone who's worth several $1 million? Say they're worth $4 million and they got $1 million in debt. Not worried at all. I mean, we're not worried at all. It's like we're not concerned at all about eliminating that debt, right? We're more concerned about eliminating the taxes on how do we get the assets to the next generation.
Right.
And sometimes we have to take on a little more debt to get the right type of assets in order to wind that up to the next generation, which we can do. And so people need to step back from these numbers and not play into the fear, because the number one thing people should be afraid of is not acquiring any assets.
Yeah, because as you get older, your earning potential does diminish. Once you get past, let's say 60, your earning potential goes down unless you have a specialized skill. But even still, even getting those jobs that are out there, it's less and less. So if you haven't been acquiring assets in your 40s, 50s, or even before that, then you could find yourself in trouble and trying to play catch up at the very end there.
Yeah.
So
I mean that's kind of what we wanted to bring for you guys today. It's like we just want to show people that the real estate market is the sky is not falling. It's a very good clickbaity thing, and like I think we've been conditioned a little bit. We had the .com bust, and we had the great financial crisis, and we had COVID, which was basically one emergency after another with government announcements for like 2 years. It's like, but the most likely outcome is not a housing crash, right? And I say like crash, it's like correction of housing's down. If housing's down 10%, that's a natural correction. Assets go up and down by 10%. It's just, we call it a correction, okay? 20% down, that's a meaningful move down in any market. If something goes down 20%, it's like, unless you're a Bitcoin, and then you just think that's another Tuesday, and that's fine. But assets, they go down 20%. The question you should ask is like, could I, am I buying into a euphoric market? I tell people that are buying real estate, it's like, get 5 years of, like, you want all of the sales in that neighborhood for the last 5 years. And then some people will tell me, it's like, well, if I get that, the house will be gone. I was like, well, that's a good reason to not buy at that time. That's telling you the market's overheated. If you don't even have enough time to do due diligence, that means there's other idiots just making emotional decisions.
Oh, for sure. Yeah.
I mean, that was, we those of us who lived in Alberta in 2007, we know it more than everyone. I mean, you saw the euphoric in Toronto. I was like, I would venture to state that the euphoria in Alberta in 2007 was off the charts.
We got stung with that. So during that time, we bought our house at almost the exact worst possible time to buy that thing.
Yeah.
And so we got into it. We were able to purchase it and finance it and so forth. But it was probably just as the housing prices were just about to go down after that peak, after the 2008 or right before the 2008 financial crisis and all of that. So right at the peak almost of where housing was, we got a little bit of a discount. But for the next 10 years that we owned that place, the actual price of that home remained stable.
Yeah.
The same. Did not change $1.
Yeah.
Like we sold it for basically what we paid for it, and we had very little equity in that house in that 10-year span. So
exactly. And if someone, they were counting on that house going up in that period. All their eggs were in that basket of house. They didn't know actually how to leverage that house. If you knew how to leverage a house, you could extract the equity out of the house and buy some dividend paying stocks at that time. In which case you actually hedged your bets. You weren't totally dependent on the house going up. You had another asset class, right? And that's really important for people to consider. It's like the main thing is it's not using debt. It's like we have to acquire assets. Like step one, like the average Canadian should be like, it's not, am I buying a house? It's like you should have, the goal is to get 3 doors. I tell people it's like you want 1 door that you live in and 2 that pay you. That's a good risk mitigation strategy because inflation is our biggest risk. The value of our time going down and down, like that is the biggest risk. It's like, I want real estate, I want dividend paying stocks, I want gold, and I want Bitcoin. And I want all 4 of those, and I'm not scared to use debt to get them. Mm-hmm. I just want to have a healthy amount of debt. And that's what we're, hopefully we can teach people. If you want to learn more about it, you can come to the boot camp. We get a little more, a little more into the weeds on how we actually, use debt effectively. What are the good ratios? And we walk people through the historical performance of the last 25 years. We zoom way out on that perspective, right? Because right now people are zoomed in, they're really zoomed in, right? They see markets going down 5% and they think that everyone's going to start selling their houses, and they forget that, most of those assets are owned by people who are like, they're marginally annoyed, if not unaware of where the interest are. They're more concerned about booking their vacation than they are about interest rates being there. And it's like, that's just how it is. And so the goal is to break into that where it's like, you're okay. It's like you have debt. It's like, and if you're not in the bottom 40%, it doesn't matter. Like right. You're not going to get margin out of that position, right? It's the people at the bottom that, they took on everything that they can handle, and they will lose it all. And they will lose it all whether it's mortgage debt or whether they borrowed money to buy stocks. Like they will lose it all because they couldn't, they didn't have enough of a buffer. So,
yeah. All right. Well, that's it for this episode. Thank you so much for bearing with us and our technical difficulties, which are getting fewer every single week. So I'm going to pat myself on the back for only one minor mistake. But join us again next week. We're going to be doing this again. Are you in Dubai next week?
I'm still here next week. Okay. So we'll be doing one last one from Edmonton, and then we're going to do 2 from Dubai.
All right.
So that'll be interesting. Yep.
Yeah, that's going to be awesome. So we're going to get to see a little bit of life in Dubai from Josh. And we'll do this over a Zoom call, and we'll see you at that point. But next week, what are we talking about next week? Do we have a plan?
Next week, we'll have a CPI print. So we will be talking about inflation, and we'll be looking at the latest CPI number and, how that's going to affect, CPI number plays into interest rates, which plays into real estate prices, which plays into stock valuation. So next week, we'll be talking about inflation and CPI.
All right. All about building money and wealth. We'll see you guys next time.
Thanks.